This unit is on the Federal Reserve System, the U.S. Central Bank. The Federal Reserve, as an organization where there's three levels. There's the national level, the district level, and the local level. The Federal Reserve System national level, you've got the Board of Governors, the Open Market Committee, and Advisory Committee. So this is national level. Janet Yellen is the chairman of the Federal Reserve System. There's 7 members of the Board of Governors, and this is the main group that actually runs the Federal Reserve. The Open Market Committee makes decisions about interest rates and money supply. And then we have the district level. There's 12 district banks in the United States that divided up into 12 districts. San Francisco is the district bank for the West Coast. And there's 25 branch banks throughout the United States, and Phoenix has got a branch bank. And then there are local banks. Not every bank is a member of the Federal Reserve. There's 3,000 banks total, and it's about 40% of the banks are actual members, and that would be Wells Fargo, Discover, Bank of America, Citibank. My old bank, Desert Schools, is not a member. They're a credit union. They're not part of it. So the Federal Reserve Board of Governors, there are 7 members. They're appointed by the President, confirmed by the Senate. They have 14-year terms. They're staggered, one appointed every 2 years. And this long term is so they're not tied to politics. Then Bernanke had 1 term, but before him there was Alan Greenspan, and he had about 28 to 30 years he was there. The Board of Governors sets the general policies, primary regulatory and supervisory agency, and they do report and give reports to Congress. The Advisory Council, there's 3 of them. The Federal Advisory Council is 12 representatives of the Federal Reserve district branches that gives advice on the health of the economy. The Consumer Advisory Council, there's 30 members. They meet 3 times a year. They go over consumer credit laws. And of course, you have the Thrift Institutions Advisory Council. They meet 3 times a year, and they represent the thrift institutions like savings banks, mutual savings banks, and credit unions. The Federal Open Market Committee is the most important, makes decisions about the growth of the money supply and the level of interest rates. There's 12 voting members, 7 from the Board of Governors, the President of the New York Fed, and 4 Fed district presidents on a rotating basis. Meets 8 times a year to review the economy, and is the Fed's primary monetary policy making body. Now we're looking at the functions of the Fed. There's about 7 of them. They're important and not in any order. One is clearing checks. There's about $60 billion per year in these debit and credit accounts. This is also for debit cards and credit cards. We're doing less and less checks, but there's more debit card transactions. Credit cards go through a different area, but if you're using your debit card, this is where to go through the Fed. The Fed is also the government fiscal agent. It keeps track of deposits and withdrawals for the accounts of the federal government. The U.S. Treasury's bank is the Fed. Social Security, tax refunds, and so on clear through the Federal Reserve Bank. They supervise member banks. They set limits for loans, approve mergers. They examine the health of banks. They hold and set the reserve requirement. And the reserve requirement is the percentage of deposits that are held in reserve that they can't be touched for making loans. This is the money that has to stay in the vaults, and that has to be there for depositors and people that want to make withdrawals. This reserve requirement can change the amount of money in circulation, so we can increase or decrease how much loans are given out by and how much money is in the system by changing the reserve requirement. The Fed also supplies paper money. They actually print money and they replace it with bills. It's printed in Washington, D.C. And, of course, regulate the money supply, determine and change the amount of money in circulation. If you increase the money supply, you're trying to help the economy and make it improve. If you decrease the money supply, you're looking at inflation. And then they make loans to member banks, anywhere from 1 day to several weeks to cover large withdrawals and shortages. The main reasons to have the loans is seasonal, like for Christmas, where banks need a lot more money. Natural disasters, where there's a problem, like Hurricane Katrina or another hurricane or any earthquake. And then financial emergencies, where a bank is going to go out of business or is having problems meeting its depositors. In comparison of the Fed to other countries, the common elements: all central banks lend money to the banks and government. All central banks hold cash reserves, and all central banks are non-profit institutions. How we're different than the other countries, basically, we're unique because member banks own Fed and own stock in the Fed. So actually, Citibank owns the Fed, and Bank of America and the actual member banks own the stock and actually are the owners, which is kind of weird. District banks design policies to fit their own district. They're flexible. They can have different interest rates or different policies. There are 12 banks, not one, which is very different from other countries. And membership is not required. 40% of the banks are members, so 60% are not members. So here is how we clear a check. So I wrote a check to my mom, and I've got a checking balance of 100. I received the check from my mom, and she actually sent it to me, so sorry about that. So it's a $5 check, and I deposit it in my account. The bank gives me $5 in my account, and then the bank X account is deducted or debited. So I get the credit of 5 and my bank is deducted. The bank sends the check to the Fed in San Francisco, so the bank now is credited, they're giving the money, but the Fed in San Francisco has had the money, they're debited, so they have lost the money. The Fed in San Francisco sends the check to the Fed in Richmond. Richmond now account is credited. San Francisco's account is credited, and the Richmond account is debited. So the Richmond account needs the money, and they send the check to my mom's bank, Bank Y. Fed in Richmond, their account is credited, and my mom's bank, Bank Y, is debited. Bank Y receives the check, debits and takes the money out of my mom's account for $5, credits the bank with Richmond for $5. So there's a lot of debits and credits just for clearing a check. So in this case, this is going to 2 Fed banks. This goes to the Fed in San Francisco and then the Fed in Richmond. Say I was giving you a check and you lived in Phoenix, the check would actually go to San Francisco and then come back to Phoenix. If we both have the same bank, say we both have Wells Fargo, it doesn't go through the Fed, it just is a debit and credit in that actual bank. Here's another way to look at it. So this is where my account, I get my $5. The bank deposit in the bank, so here it is, plus 5, Bank Y is minus 5. Now Bank Y is plus 5, Fed San Francisco minus 5. Fed San Francisco now is plus 5, Fed in Richmond's minus 5. Fed in Richmond now gets the $5, but Bank Y is out. Bank Y is got the money, and then my mom has the money to deposit it. So my mom had 100 minus 5 is 95. I have 100 plus 5 is 105. So that's another way to show how it clears. The components of the money supply. So we see this green here. That's mostly savings. Here is our checking accounts, which is most of it. And look at it, you see the currency of savings bonds, other near money that could be money, say not money markets, but it could be other small savings accounts, vacation accounts, and things like that. And so this is the components of the money supply. This is the Federal Reserve System. This is just a short overview of it. If you have any questions, feel free to ask in class. You can also post after the video or ask in class.